Welcome back to the Deep Dive the Talk Tickers edition. Today we are plunging headfirst into the recent earnings call for Carnival Corporation and PLC. You know them as CCL.
And this call, which was held on December 19th, it really marks a critical pivot point for the company.
It absolutely does. Our mission today is to filter through all the numbers and the management commentary and really explain why this one matters so much.
Yeah, because Carnival didn't just, deliver strong results. They hit some crucial financial milestones. And way ahead of schedule, that signaled the end of their whole post-pandemic recovery.
And the beginning of a massive pivot back toward rewarding shareholders. That pivot is the real story here, isn't it?
It is. You saw the market's verdict almost immediately. The confidence from management was just met with massive enthusiasm.
Okay, so let's unpack that. Let's start with the results snapshot. What were the headline numbers that just drove that stock reaction?
Well, it was a classic beat and raise scenario, but the beat was so dramatic, it overshadowed everything else.
Yeah.
Revenue came in a little light, actually. They reported $6.33 billion against a $6.37 billion consensus. So a small miss.
But nobody cared about that.
Nobody cared. Forget the top line, because the bottom line just absolutely exploded.
All right, tell us about that adjusted diluted EPS figure.
It landed at a phenomenal 34 cents.
34 cents.
Yeah, and that is a 36% beat over the consensus estimate of 25 cents.
Well, 36% beat.
When a company of this size beats by that kind of margin, the market doesn't look back. The strength of the profit and the outlook became the only things that mattered.
Absolutely. We saw the stock trade up nearly 10%. That's a gain of over $2 a share in a single day on just massive, massive volume.
And management was feeling it. They were repeatedly using the word record to describe their performance.
And they earned it, right?
They definitely earned the right to use that word. They noted historical Q4 highs for revenues, for yields, operating income, EBITDA, you name it.
So this was the culmination of a lot of hard work.
Exactly. They said they delivered another very strong quarter to finish a fantastic year, which outperformed their own initial guidance by more than 30%. This wasn't just a little bit of improvement. This was the big finale.
Okay, let's explore the quality of those earnings then, because a profit beat like this isn't just about cutting costs. It has to be driven by some genuine demand.
Oh, the quality of the earnings was pristine. Q4 net yields were up a really robust 5.4% year over year.
And we should probably clarify for you, the listener, whenever we talk about yields or costs, we always use constant currency.
Right. It just means we're removing the noise from foreign exchange rates so you can see the true operational performance.
And operationally, they were firing on all cylinders.
Completely. Maximizing revenue per guest. And it was driven by two main things. Really strong close-in demand, so last-minute bookings, and just an acceleration in robust onboard spending.
And that forward visibility is arguably even more important. How's the demand picture looking as we head into 2026?
It's setting new records. Customer deposits hit an all-time high of $7.2 billion. That's up 7% year over year.
Wow.
And what makes that data point so fascinating is the context that management provided about the broader economy.
Right. I want to focus on that because we constantly hear these macro warnings, about the struggling consumer, yet the demand for cruises seems unstoppable.
Management highlighted this exact disconnect. They specifically noted that U.S. consumer sentiment readings dipped, and this is their quote, pretty close to its lowest level in recorded history during 2025.
And yet people are still booking cruises.
They are. Their guests continue to prioritize these vacations. And if you look at the economics of it, it makes sense. Cruises offer a highly predictable, almost inflation-protected vacation compared to land-based alternatives.
Hotels, airfare, restaurants.
Exactly. All of which have been hit way harder by inflation.
So phenomenal demand strength. But the real catalyst for that 10% stock jump wasn't just bookings, it was the balance sheet triumph. This is the structural story.
This is the bedrock of the entire thing. Over the past year, Carnival successfully completed a massive $19 billion refinancing plan. A mammoth undertaking.
And structurally, they've now reduced their total debt by how much?
Over $10 billion. $10 billion since the peak less than 3 years ago.
That is an extremely aggressive pace to repair a balance sheet.
It was, and it paid off. This work culminated in them achieving an investment-grade net debt to adjusted EBITDA ratio of 3.4 times at year-end. And they did it ahead of schedule.
Which is huge. They actually got the investment-grade rating from Fitch, and they're just one notch away with S&P.
Right. And achieving those metrics is so critical because it fundamentally lowers your cost of doing business. It's the key that unlocks this whole new capital allocation phase.
So we can actually quantify that benefit.
We can, immediately. This deleveraging and refinancing effort is expected to result in an over $700 million improvement in net interest expense in 2026 compared to 2023.
And that's not a variable saving like hoping for cheaper fuel.
No, this is a permanent structural reduction in their debt costs, and it flows straight to the bottom line. It just de-risks their entire future.
Okay, so they've cemented their financial health. The next question is, how do they grow from here? Let's move to that 2026 roadmap, because the guidance was equally strong.
The forward guidance just affirmed that double-digit growth trajectory. They projected adjusted EPS for the full year 2026 at about $2.48.
Which beat the street estimate of what, $2.43?
Exactly. They explicitly framed it as another year of double-digit earnings growth.
Which implies a huge boost to overall profitability.
It does. They expect to generate over $350 million more to the bottom line year over year. That gets them to about $3.5 billion in adjusted net income and $7.6 billion in EBITDA.
And critically, this growth is coming from yield improvement and pricing, not just adding more ships.
Right. They're holding the line. Net yields are guided up 2.5% in constant currency. But if you normalize that for a couple of accounting changes.
The loyalty program and some deployment shifts.
Yes, the Carnival Rewards program. If you normalize for that, the underlying yield target is actually 3%. And this is all happening while their capacity increase for 2026 is projected to be less than 1%.
That is the definition of pricing power. Selling barely any more product, but for a lot more money.
It is.
But that puts pressure on cost control. If capacity isn't growing, what did the deep dive into their costs reveal?
Costs are being tightly controlled, but you have to understand the metric. They guided for adjusted cruise costs ex-fuel per ALBD to be up 3.25%.
And let's quickly define ALBD for you. It stands for Available Lower Berth Days. It's just the standard industry metric for capacity.
Exactly. Now, that 3.25% is the headline number.
Yeah.
But management quickly normalized it for us. If you exclude the partial year costs of new destinations like Celebration Key and a timing shift of some expenses,
The real number is lower.
much lower. The normalized rate of increase is closer to 2.5%.
So they're successfully fighting off broader inflation. How are they managing that?
They pointed out that 1.1% of that cost increase is actually offset by new efficiency initiatives and leveraging their scale. Better purchasing power, optimizing supply chains, things like that. They're finding real savings.
They also mentioned regulatory costs, which are unavoidable.
Right. They detailed an 11-cent per share cost from things like EU emission allowances and the new Pillar 2 global minimum tax. But here's the critical part. The step up to 100% coverage for those EU emissions is now complete.
So that big one-time jump in costs is behind them.
It is. The risk is over, which gives them a lot more predictability going forward.
Okay, let's briefly touch on the first quarter outlook because the yield improvement there seems a little softer. Is that a concern?
It's a nuance, but not a concern once you see the context. The Q1 normalized yield improvement is lower at 2.4%. But that's because they are up against an incredibly difficult comparison.
The prior year was a record.
A massive record. Q1 of 2025 saw a 7.3% yield increase. So they aren't slowing down, they're just comparing this year's great results to last year's historic results.
Got it. It's more like maintaining cruising speed after hitting max velocity.
That's a perfect way to put it. And that Q1 forecast already incorporates the huge 14% capacity growth from competitors in the Caribbean. Management was clear, they're focused on price integrity, not just filling every last bed.
That shows real discipline. Okay, let's pivot to the investors. The capital return, what was the immediate shareholder reward?
The board formally resumed the dividend. The initial rate is 15 cents per quarter. It's a huge signal of their confidence in the future.
And beyond the cash, they propose simplifying their entire corporate structure, getting rid of that cumbersome dual-listed company or DLC structure.
This is a major catalyst that goes way beyond just operations. The plan is pretty straightforward. Carnival PLC shareholders get Carnival Corporation shares, 1-for-1. Then the PLC shares get delisted from London, and it all just becomes one company based in the U.S.
And the strategic reason for doing this now?
Well, it streamlines governance and saves a bit on admin costs.
Yeah.
But the big prize here, the most important thing for the stock price, is that it increases stock liquidity and massively improves their weighting in major U.S. stock indices.
And we should explain why index inclusion matters so much.
It matters because of passive money. When your weighting goes up in an index like the S&P 500, all the ETFs and mutual funds that track that index are automatically forced to buy your stock, billions of dollars.
Which creates a huge, steady demand for the shares.
Exactly. It can lower the risk premium and push the stock into a whole new valuation bracket. They're targeting completion for Q2 2026.
Very specific timeline. And quickly, before we get to our trade idea, what about non-ship growth drivers?
Destination development is a huge focus. They're leveraging their new private destinations like Celebration Key, which has already seen over 1 million guests. They're turning these ports into proprietary assets that drive bookings.
And the tech side.
Leaning heavily into AI, specifically for yield management, so dynamic pricing, to get maximum value from every single sailing. And also for marketing and personalization, which drives that high onboard spending.
Okay. This is the Dope Dive, and we must always remind you, the learner, that this analysis is based on the source material for educational purposes only. This is not financial advice.
But now
It's time for the segment we call the catalyst trade. The stock popped on achieving investment-grade metrics, so the trade needs to focus on the next major structural catalyst.
the market has already paid for the dividend and the healthy balance sheet. So what do you look now?
You look at the governance and that final mile of deleveraging. The trade here is to buy long-dated call options, let's say targeting the Q3 2026 expiry.
So this is a bet on the successful completion of that DLC unification.
It is. The thesis relies on that timeline. The simplification is targeted for Q2 2026. If that happens, the index inclusion gains, that passive money we just talked about, will start flowing in.
And you combine that with them hitting their final debt targets.
Absolutely. Management is projecting a 2.8 times leverage target by year-end 2026, which is below their own goal. That combination will attract a new class of institutional money and lower the perceived risk. The stock is trading on great fundamentals now, but this is the structural re-rate that could push it into a higher multiple bracket.
So you're betting on governance and the mechanics of the market, not just the booking curve. I get it.
So let's bring this all home. What are the most crucial takeaways for you, the learner, to carry forward from this call?
I'd say first, that exceptional 34-cent EPS beat and the return of the 15-cent dividend. That signals the company has moved from survival to cash generation mode. And second, the strong 2026 guidance points to another year of double-digit growth, driven by yield and cost control, not just sweet growth.
And the critical thing is that management hammered home the structural improvements. That guaranteed $700 million interest benefit, the deleveraging, the corporate simplification. These are foundational changes.
Right. It suggests future performance is now less reliant on, a sudden good economy and more dependent on their own execution and capital allocation.
Which leaves us with a final thought for you to mull over as you watch this company in 2026.
How will they manage that delicate balance between increasing the dividend to reward investors now versus aggressively hitting that final sub-3 times leverage target? Which of those two milestones will the market reward more heavily over the next year?
A great question to end on. Remember, this analysis is based entirely on the source material provided and is not investment advice. Thank you for joining us for the deep dive.
We'll see you next time.